Move on and talk more about markets and, of course, how the Q4 earnings season has been panning out. We have Nikhil Khandelwal, who is the chairman and managing director at Systematix Group, joining us. Nikhil, good afternoon. So good to have you here. Let me start off with the first question. That's your on the markets, given that they have been fairly volatile. And while we have been waiting for the resolution on the West Asia front, but fresh tensions have emerged. So, what are your first thoughts on the conflict and, of course, its implications?
Audible?
Yes, you're audible.
All right. Hi, good afternoon. No, actually, the I think the market has been quite busy with all the data or all the developments coming from the West Asian crisis. When we thought that things are going to cool off, again, some more developments have happened over the last 24 hours as far as Iran and UAE is concerned. So I think a result of that has been the elevated oil prices. And I think that's been the biggest factor playing as far as Indian economy is concerned, whether the disruption on supply chain, the high commodity prices, and of course the most significant impact on rupee. So in the context of all this happening in the global markets, and which is directly impacting India and the Indian consumption per se, we have been seeing that most of the capital continues to get deployed in more, I'll say, domestic market driven and more consumption driven sectors. So a lot of the capital continues to get deployed in businesses which are not too dependent on global market sales, like export driven businesses are not too much driven by the commodity inflation. So a mix of that, I think the most of the capital is going in more safer sectors like consumption and financial services.
Got it, got it. Nikhil, markets have been pretty much stayed sideways after after rebounding from the March lows. I mean, do you think that the markets are going to remain in the similar way, or what would it take for another leg of rebound that we saw since March?
Yeah, see, if you see the data, the Nifty is just about 9 to 10% off its highs. So the in markets per se hasn't really done badly. What I think the market is waiting for, and from our conversations with the fund managers across domestic as well as foreign institutions, is I think stability on the rupee dollar front, stability on the commodity, the crude oil front. I think as that stability comes, maybe below $100 for crude, and the rupee dollar being relatively stable for even a couple of weeks, I think that will give a significant direction to the market. Our assessment is that the worst on all these macro fronts is behind us. As a result of which, this year we expect that the market, the Nifty per se, should give between 10 to 12% return, while certain sectors which we remain overweight would outperform from where we are from the Nifty returns from a 1 year perspective. So for this year, we believe that the macros will settle down, maybe in a few weeks or few months, and Indian corporates are becoming more resilient to managing crisis. So as those earnings start to pan out from Q2, Q3 onwards, we will see the markets catching some wind, and overall we expect a low teen return from markets.
Okay, got it, got it. Nikhil, what was the earlier estimate that you were working with before the war started for FY27? And of course, what is the revised one that you're working right now?
No, so I think the earnings revision is something which we are still, I'll say, digesting, because a lot of the companies are yet to themselves analyze the impact of commodity prices on their revenues, on their profitability. Some of the companies have significant impact on their production. Some are operating with significantly low inventory levels. So a lot of that data we are still kind of in the process of analyzing. What we are saying is that this will impact the PE, which is ascribed to the Indian market. So from our earlier estimate of India being priced at close to about 25, 26 P on FY27 earnings, we are currently pricing it at about 22, 23 times earnings. Currently, we believe that on our estimates as of last couple of months for FY27 basis, we are currently trading at about between 19 to 20 times, and 22 to 23 times earnings is what we are pricing for the Indian markets from a 27 EPS perspective. So we are yet to, however, downgrade EPS wherever it gets impacted. So, but we are budgeting it for it in the earnings multiple for the market, which is basically the long time average of Indian market is between 22 to 24 times, and we are saying that Indian market will trade it at the lower end of the long term average. So that's how we are seeing. That's the reason we are seeing about 12% odd return on the market from a 1 year perspective.
Okay, got it. 12% return from a 1 year perspective. Nikhil, your first thoughts on how the Q4 has been panning out? Is it in line with what you were expecting, or any key highlights that you have gathered from the Q4 results?
The Q4 results are, I'll say, a lot of benefit. I'll say the companies have gained from price inflation, which is showing in profitability of automotive companies, of consumer durable companies. They have been operating with inventories which were at lower price inventory, and they have been able to liquidate a lot of their products at a little higher prices. So that shows in better profitability and better revenue compared to some of the estimates. However, we are see what we are seeing in terms of the earnings is the impact on their volumes starting March, and even discussing with companies on their volume impact in April, and as the month of May has started, and there we are seeing that companies which are significantly linked to commodity prices like paints, a lot of companies which are fine chemicals, etc. They have taken significant hit in their production volumes. They are also company. These are also the companies or sectors which are not so don't have that much flexibility to increase their prices end prices. So they are not able to consume. They have to consume a lot of that cost within themselves. So the margin impact in companies like of those nature is significant. So we are looking at those data, and we are accordingly advising our clients to be underweight in certain sectors like paints and chemicals, and maybe go more overweight on sectors which are able to consume these kind of price inflation like automotive, sectors like power, etc.
Okay, got it, got it. But before we move on to more sector specific, Nikhil, I want to know about your idea about the broader end of the markets, particularly for the small caps, because we have seen that in the past 1 month, there's a lot of optimism which has gotten built into the Nifty small cap index, and of course the small cap stocks as well. Do you think this kind of rally is sustainable for this particular segment going ahead, or do you think that it has already reached a peak point and it is running ahead of the fundamentals?
No, I think the small cap index has obviously been the most impacted in the market fall. In fact, more than the general fall of the index, the general capital allocation as far as the small cap stocks as well as the small cap mutual fund schemes, etc., has been at its low over the past of so many years. So I think it's just generally been underinvested. There are, of course, fantastic businesses in that pack, and the only factor is that there are more illiquid stocks. So as a result of that, once a capital allocation starts to trickle into the small cap stocks, and it's bound to see a stronger rally compared to a mid or large cap. So I think that index will continue to see. I mean, in our view, will be a significant outperformer this year. The earnings momentum across some of these smaller companies is actually going to be sharper than in the larger companies. And they're underinvested. So, combination of these factors, we believe that the small cap index and small cap companies will actually surprise on the positive side, and are likely to see continued momentum as people can start to load up a little bit more on this category, which they have actually ignored over the past 12 months or so.
Hmm. Okay, got it, got it. You were mentioning something about the auto sector where you're positive on. Of course, you've seen a broad-based growth across the companies. M&M has delivered, good Q4 performance. But on the margins front, do you think the companies will be able to tackle the raw material inflation cost and, of course, the oil price surge?
No, I think cost pressure is going to be impacting one and all. There is no
Hmm.
company which can absorb what's happening, or in the macro economic situation. Prices of aluminum are 2x, prices of steel are close to 40% up. So I mean, almost all the commodities which go into plastics, every product is seen minimum of 30-40% to up to 100% increase. So definitely the price impact is going to show in each and everyone's books. A company like Ather, which is in EV scooter business, reported one of its best years of growth, but has been significantly impacted by, again, the price of batteries and all the other raw materials. So I think that factor has to be seen in the context of who is actually developing products which are across the spectrum, from mid to premium category, who is gaining more market share. And in general, I think some of the categories, whether it's the EV category or whether the SUV category, they are quite underinvested as far as Indian automotive sector is concerned, in terms of the ownership of these vehicles. So we believe that companies like M&M, companies like Ather, would see continued momentum in their market share gains, and and whenever the price pressure kind of abates, these companies will start to show significant outperformance on margins as well. Till the time the margin issue kind of remains hanging, these companies will outperform by their volume growth, and when margin issues kind of come off, they will be outperformers on the profitability front. But net, we believe that within the consumption pack, automotive will be one category which will see one of the highest volume growth, driven by the car makers and two-wheeler companies. And we prefer some of the names like M&M, Maruti, Ather, and TVS Motors in this larger pack of automotives.
Hmm, got it, got it. Autos are something that you're bullish on. Nikhil, we have had a lot of realty stocks that have reported their good numbers. Shobha, Godrej Properties, all of them reported decent growth in bottom line and top line. But we've seen the stock prices gaining traction from the last month. So, what's your assessment here? And of course, anything that you're liking from the realty space?
Well, on reality, our view is that the stocks had all run significantly ahead of the fundamentals. The stocks have of course fallen close to, I think if my data is right, between 40% to about 60% from their highs. And of course, over the past 2 months, the on an average, I think the stocks have gone up from 10% to about 30% from their lows. So I think the general, from a price and from a valuation perspective, we believe that the sector is, I think, fairly valued. We believe that the sector and the companies will continue to do well. Uh, However, I think the valuations had run quite a bit ahead of its fundamentals, and how the companies like Prestige from DLF and some of the other larger companies like Oberoi and all are now valued. They seem quite fair. There is, of course, a lot of launches which most of these companies have lined up. A lot of the execution which pipeline which these companies are in midst of, A lot of that has to be tested through time now over the next few months and quarters, where how their volume kind of pans out, where they are able to protect the premium on prices which they had launched these projects with. I think that will be tested over the next few months and quarters, and people should wait to see some of that data before they go all in further loading up these stocks in the portfolio.
Okay, got it. Nikhil, you mentioned power as a theme also that you are quite bullish on. I mean, we've seen that plenty of the stock prices have already run up. In terms of valuations, how are you finding at the current levels? And of course, going forward, how can investors play this theme?
I think power as a theme is quite. I think that cycle has been on an uptrend for the past 5 6 years. India is a heavy power guzzler with the investment which is happening across the new age capacities around data center, etc. The need for power has become even more sophisticated, and not just the volumes are increasing, but the need for quality power, for consistent power is going up significantly. India is underinvested in its transmission and distribution capacity. A combination of these factors is what is leading to companies investing in the transmission and distribution space, whether from an EPC perspective or from a power equipment perspective. I think that category continues to see significant order book momentum, continues to see significant price resilience, and significant investment in high voltage capacity. So the companies which are invested in have the ability to manufacture high voltage equipments, whether conductors, cables, transformers, or companies which are have the ability and are executing large scale transmission and distribution projects like the Kalpatarus and the Techno Electrics, etc. All of them are going to be significant outperformers in the market. So from that perspective, we are quite bullish. We also are of the belief that given the thermal capacities are going to be constrained, so a lot of the investment will continue to flow into renewable energy, and hence companies which have significant investment happening in wind or solar energy from a production perspective are also going to be significant beneficiaries of the entire power sector category in India. So yeah, from both producers as well as transmission distribution beneficiaries, this sector is seeing continued momentum in order book, in demand, in price resilience, and hence we believe that these companies will not just show revenue and volume growth, but will also show continued resilience on margins.
Okay, got it. Because of the summer heat wave, consumer durable stocks have also come into focus apart from the power theme. I mean, how are you placed here? And in terms of valuations and, of course, the growth visibility, how are you finding the consumer durable space?
I think consumer durables as a space is also fairly valued in general. The companies are, the summer has been a little delayed, but the summer has been strong. The companies are seeing strong volume growth in their air coolers or air conditioners and all the related products. So I think that that bit of momentum is there. But we have to see it in the context that a lot of these companies had actually built up a lot of inventory towards the fag end of the last year. So the December quarter and even the March quarter for a lot of the companies have actually been quite poor. If you see from contract manufacturers like Dixon, etc., they've had a very difficult quarter in Q3 and Q4 last year. So a lot of that inventory is actually getting consumed. So I think that is one. So the benefit of the summer, etc., on these companies is fairly priced in now, and the stocks have run up between 20 to 30%. We don't see this sector or these companies outperforming the index significantly from here on.
Okay, got it, got it. Anything else apart from autos and powers where you are retaining a bullish stance?
Well, we are quite positive on whatever has been happening in the larger telecom sector, and while Airtel and Jio have been strong performers in terms of subscriber addition, ARPU growth, and profitability, the Vodafone Idea situation has also started to become more comfortable as far as their own cash flows are concerned, the AGR payments are concerned. A direct beneficiary of this entire positiveness in the sector is Indus Towers, and that has been one company which we have been advising our clients to kind of play the sector through. It trades at about 11, 12 times earnings, has very strong profitability, outlook, is also now having Bharti as a very strong promoter who has also announced creeping acquisition, is now a dividend paying company. And it's one of his larger clients, Vodafone Idea, which has been a little bit under the weather, is also started to do well. So, combination of those things, we believe Indus Towers is one company which should be considered from a long-term investment perspective, and that comes from our general positive perception and outlook on the telecom sector in India.
Okay, got it, got it. All right, Nikhil, with that, we have to let you go, but appreciate your time and thank you so much for joining us.
Thank you.